There is this fundamental law of corporate gravity that I think most investors just accept as absolute truth. It's the idea that business growth is, it's a straightforward physics equation, right? You push the top line revenue up, and assuming you aren't completely mismanaging your costs, the bottom line profit goes up with it.
Right, yeah.
You serve more customers, you move more product, you make more money.
Yeah.
It's a very clean, intuitive narrative.
It is. I mean, it's in the baseline assumption for almost every financial model out there.
Yeah.
We inherently trust scale. When a company reports that revenue is shrinking, the immediate reflex across Wall Street and, retail investors alike is to assume the company is in trouble.
Right. The sky is falling.
Yeah.
But then you encounter a situation that completely inverts that law of gravity.
Which is exactly what we have today on Talk Tickers.
Oh, absolutely.
We are doing a deep dive into the Q2 2026 earnings call for Key Holdings, ticker symbol BEKE. And for anyone who isn't familiar, they are a massive player in the Chinese real estate market, which is a market that has been under intense, well-documented pressure lately.
Yeah, heavy pressure. And their earnings report presents us with a genuine structural mystery. I mean, how a company in this environment managed to see its revenue shrink, yet absolutely skyrocketed its profits.
It's crazy. The divergence between their top line and their bottom line is aggressive enough that it really demands a full teardown.
Exactly.
This isn't just a slight variance. We are talking about two crucial financial metrics moving in violently opposite directions.
So our mission today on Talk Tickers is to give you that actionable, data-forward, jargon-free analysis. The goal is to deliver a concise, under 5-minute breakdown of the headline numbers, the story driving them, and our ultimate bullish or bearish verdict, even if we have to spend this entire deep dive completely tearing the machinery apart to get there.
Yeah, let's get into it.
Okay, let's unpack this.
Okay.
Because on paper, the headline numbers almost look like a typo.
Yeah.
Let's start with gross transaction value, or GPV. This is essentially the total dollar amount of all the real estate transactions facilitated through their platform.
Yeah.
For Q2, GTV actually grew 6.3% year over year.
Which, tells us a very specific story about user behavior.
Right.
Despite all those macro headwinds in Chinese real estate we just mentioned, activity on their specific platform hasn't dried up.
Yeah.
A 6.3% increase in GTV means the sheer volume of commerce moving through their ecosystem is actually expanding. People are still buying, selling, and renting homes using their infrastructure.
But here's where the gravity inverts. More money is flowing through the platform, right? But Key Holdings' total revenue actually decreased by 5.7% year over year.
Yeah, that's the kicker.
They are facilitating more total commerce, but capturing less of it as top-line corporate revenue. And look, if I'm a retail investor just glancing at a stock screener, a roughly 6% revenue drop usually triggers a sell instinct.
Sure, it does. But that instinct is exactly what management is hoping long-term investors will look past, because the third data point completely recontextualizes that revenue drop.
All right, let's lay it out. While revenue shrank by nearly 6%, their non-GAAP net income exploded by 74.9% year over year.
It's just a massive jump.
It is, hitting 3.2 billion RMB. And their gross margin expanded by 6.7 percentage points to 28.6%. Not to mention, their non-GAAP net margins hit a 3-year high of 13%.
Yeah.
So I have to stop here. When a company's revenue falls, but their profit spikes by 75%, my first thought isn't, operational efficiency.
Right.
First thought is, are we looking at some sort of accounting gymnastics here?
Look, it is the logical question to ask. Any time profit decouples from revenue that sharply, you have to look for the mechanism.
Right.
But in this case, it's not an accounting trick. It is a fundamental structural transformation of their cost base and what kind of revenue they prioritize.
Okay, let me test an analogy on you to make sense of this paradox. Because initially I was trying to figure out how you make more money with less revenue. So try this.
Okay, let's hear it.
This is like a restaurant, right? They're serving slightly fewer tables than last year, so the overall revenue is technically down.
Okay.
But they're making almost double the profit because they stopped giving away these really expensive free appetizers. And they completely optimized their kitchen staff, so there's zero wasted labor.
That is actually a perfect way to visualize it, yes.
Yeah.
They cut the fat, their operating expenses, their OPEX, fell by 14.1% year over year.
Wow, 14%.
Yeah, down to 4.0 billion RMB. And they proactively shifted toward higher margin platform service revenue while initiating really strict financial discipline across the board.
Okay, so that leads us perfectly into the second part of our deep dive,
Oh.
the story behind the numbers. How exactly did management execute this massive efficiency boost on the ground level? Because cutting 14% of OPEX usually means breaking a few things.
It usually does, yeah. But they didn't just slash budgets blindly. They reorganized the actual workflow. And to understand how, we have to talk about the ACN.
Right, the Agent Cooperation Network. This acronym came up constantly in the source material.
Yeah.
So let's translate the jargon here. For a retail investor trying to understand the moat of this business, what is the ACN in plain English?
In plain English, ACN is essentially their internal operating system for sharing commissions.
Okay.
Historically, real estate is this intensely zero-sum, eat-what-you-kill kind of culture. A single agent finds the seller, lists the property, markets it, shows it, and handles the closing.
They do everything.
Right, they do it all to keep the whole fee. But Key Holdings is transforming the ACN from a simple single transaction model into a truly modular ecosystem.
A modular ecosystem. What does that actually look like?
It means specialized roles are paid for specific tasks. Instead of one agent juggling everything, you carve the transaction up into modules. One agent specializes in 3D property tours, another focuses on legal contracting, another just does physical showing.
Oh, I see. So it's an assembly line.
Exactly.
Yeah.
And everyone gets compensated for their specific module, regardless of who finally closes the sale.
That is a massive cultural shift for salespeople. But there was another piece of this operational shift that I think is the real alpha here, the AI.
Yes, the AI integration, this is huge.
The source material highlighted a staggering data point. Beak introduced an AI-assisted client manager role. And this AI handled over 50,000 leads.
It's incredible scale.
It is. And the result of that was a 7.4% showing conversion rate.
Which is just crushing the broader market.
Right, because the market average is what, around 5%?
Yeah, the industry standard is right around 5% for converting a cold lead into an actual physical property showing.
Wow.
So going from 5% to 7.4%, that might sound like a small delta to some people.
Yeah, a couple of percentage points.
But when you apply that across 50,000 leads, that is an astronomical volume of extra foot traffic that the AI generated just by being more efficient and objective than a human at the top of the funnel.
That makes total sense. The AI does the heavy lifting, diagnoses exactly what the buyer needs without any commission bias, and hands a warm, organized lead to the human agent.
Exactly. The human can just focus on closing and empathy.
But it wasn't just digital reorganization, right? There's a very physical, on-the-ground reorganization too. I want to highlight the cultural shift here, because CEO Stanley Peng literally forced his city managers out of their meeting rooms.
Yeah, he told them to get on the front lines.
Right. He made them go to the signing centers and physically deal with stale listings themselves.
He realized that management by spreadsheet doesn't work in real estate. It's too hyper-local.
So they changed how they define their service areas. They divided these big city districts into much smaller microblocks.
Yes, and the efficiency gains from that microblock strategy were incredible. Leasing agent efficiency jumped from 3 transactions per agent to 5.6 transactions.
They nearly doubled their productivity.
Yeah.
And the craziest part to me was the retention data. The percentage of agents with absolutely 0 transactions dropped from nearly 25% down to under 10%.
Right, which fundamentally stabilizes your workforce. If your agents are actually closing deals and eating, they don't quit. You save a fortune on turnover and training.
Okay, so that explains the profit explosion. But we still have to explain the revenue drop, because the expert analysis in our notes clarifies that the revenue drop was actually a deliberate choice by management.
It was, specifically in their home renovation segment.
Right. Home renovation revenue fell by a massive 30.1%.
Yeah.
And normally you'd think, oh no, competitors are stealing their market share.
But that wasn't it. Management looked at the unit economics in certain lower tier cities and realized they were just burning cash to compete in price wars. So they proactively exited those inefficient cities. They chose to stop chasing bad revenue.
They sacrificed the top line to protect the bottom line.
Exactly. It takes a lot of discipline to willingly report a 30% drop in a business unit, but it stopped the bleeding.
Which is the perfect transition to the third part of our outline, management guidance and capital allocation. Because all this cost cutting, the AI efficiency, exiting bad markets, it means Key Holdings is generating a ton of cash.
A literal war chest.
Yes. So what does this all mean for the company's war chest and their future outlook? Let's hit the core data. They are currently sitting on a broad cash balance of 67.3 billion RMB.
I mean, just think about that number in the context of the Chinese property sector right now.
It's wild. You have major developers defaulting, going bankrupt, and Beek is just sitting on 67 billion RMB.
It as a fortress balance sheet. It provides immense downside protection.
And they are using it. They executed $250 million in share repurchases in Q2 alone.
Yeah, and that included their first ever buyback in the Hong Kong market, which is a great signal.
So if you look at the total buyback since they started this in September 2022, they have reached roughly $2.99 billion.
Which is returning a massive amount of capital to shareholders. It mathematically increases the ownership stake of every retail investor holding the stock.
Right. It's a huge transfer of value. But even with all this cash, management isn't wearing, rose-colored glasses. The CEO, Stanley Peng, and the CFO, Tao Zhu, gave some really sober guidance.
Very sober. They described the current housing market as polarized.
Polarized. Let's dig into that. What does that mean for their strategy?
It means the demand isn't uniform anymore. It is highly concentrated in high-quality supply and core Tier 1 cities.
Okay.
In those specific areas, transaction volumes are resilient. But everywhere else, prices are continuing to adjust downward. The scarcity narrative is just gone.
So management is not relying on some magical market rebound to save them.
Not at all. They made it very clear. They are enforcing strict ROI discipline. They are focusing on deep data, and they flat out refuse to return to that era of extensive expansion just for the sake of scale.
They won't grow just to grow.
Right. Every dollar spent has to be justified.
Which brings us to the most important part for our Talk Tickers audience. Section 4, the bottom line. I'm going to ask you to pull all of this together for the retail investor listening right now. Look at the numbers, the AI, the cash. Are you bullish or bearish?
I am taking a firm, opinionated stance here. I am definitely bullish.
Okay, bullish. Give me the rationale. What is it? So what's for someone holding or considering this stock?
The so what is that this quarter proves the company has built a much healthier cost structure. They are successfully decoupling their profit from pure scale.
Meaning they don't need the whole Chinese real estate market to boom for them to make money.
Exactly. Because they have dramatically lowered their break-even point, they have massive downside protection. But more importantly, if the Chinese property market does eventually rebound, the operating leverage they've created is going to lead to massive profit upside.
Because they won't have to hire 1,000 new agents to handle the volume.
Right. The AI and the modular ACN can absorb the new volume without skyrocketing their fixed costs. Plus, while you wait for any macro recovery, management is aggressively returning capital to you through those buybacks.
That's a very compelling setup. You have a management team that is prioritizing actual profit over vanity metrics. So as we wrap up this Talk Tickers deep dive, the main takeaway is really the value of looking past the top-line revenue miss. You have to see the underlying operational mastery.
Absolutely. The headline revenue shrinking was actually a sign of them getting smarter, not weaker.
Yeah. But before we sign off, I want to leave the listener with a final, slightly provocative thought to mull over.
Okay, lay it on us.
It's based on a key quote from CEO Stanley Peng from the earnings call. When they were talking about the AI client manager, he noted that, quote, AI does not bear the consequence of poor decisions.
Wow. Yeah, that's a powerful statement.
It really is. It's why humans are still desperately needed in this process for accountability. Because buying a home is the biggest financial risk most families ever take.
Right. If the AI recommends a bad house, the AI doesn't lose sleep or face bankruptcy.
Exactly. It has no skin in the game. So, my thought for everyone listening is this. As AI inevitably takes over all the grunt work, the matching of static listings, the scheduling, the data crunching, will the future real estate agent cease to be a salesperson entirely?
Oh, that's an interesting framing.
Right. Like instead of a salesperson, will they become something closer to a high-stakes risk management consultant?
Yeah.
Someone you pay purely for their judgment and their human accountability.
I think that is exactly where the industry is heading. The value won't be in finding the house. It will be in mitigating the risk of buying it.
Exactly. And Key Holdings seems to be the one building the exact infrastructure to profit from that future. So keep an eye on BEKE. Thanks for diving into the data with us today.
Thanks for having me.
We'll catch you on the next deep dive.